Hello, everyone, and thank you for joining us today. I'd like to welcome you to today's webinar on portfolio management and agricultural lending. For this topic, I'd like to welcome a very distinguished guest speaker, Mr. Allyn Lamb, who's the former president and CEO of AgChoice Farm Credit for over 14 years. Prior to that, Allyn served for 28 years in various leadership roles with Farm Credit East's predecessor organizations. For those of you that don't know what the farm credit system is in the United States, it is a nationwide network of borrower-owned lending institutions and specialized service organizations. So Allyn is going to speak with us today about portfolio management. This is a topic we haven't touched upon much in our webinar series. You will have the opportunity to learn about the different types of risk in agriculture, how to manage and price those risks, and how to stress test your agricultural loan portfolio to measure and mitigate that risk. Now, I wanted to provide you a bit of background. Allyn presented on this very same topic during our last annual conference. After his presentation, many bankers came up to me and said, wow, this is really something we need to learn more about. And we really would like to incorporate this into our own bank systems back home. So although you may think that because Allyn is talking about portfolio management from the context of the American ag market, we really think that you'll find many lessons in today's presentation from which you can draw upon and apply to your own circumstances. For those of you that are new to AgriFin, in our webinar series, AgriFin aims to catalyze learning about successful agricultural finance models and practices through the sharing of practical information and fostering peer-to-peer exchange. The webinar series is an important way that we accomplish this goal. Through this series, we engage commercial bankers to share their insights and experiences with you on specific products and processes that work well in their respective markets. So before we get started, I would just like to let everyone know how things will follow. We'll begin with Allyn's presentation, which will be about 25 to 30 minutes long. This will be followed by a Q&A session with the speaker for about 20 to 25 minutes. For this, please feel free to write your questions during his presentation in the chat box located at the lower right-hand corner of the screen. Please choose all when you're typing in the chat box so that all attendees can see your questions. And please do write your questions during his presentation. It is our responsibility to take those questions, organize them for the facilitated Q&A session. So please don't wait till the last minute to get your questions in. So without further ado, I'd like to hand it over to Allyn, who will begin his presentation. Thank you, Allyn.
Thank you very much, Maria. It is a pleasure to be able to do this, and I'm glad you raised the point that although this topic is entitled Agricultural Loan Portfolio and Risk Management in U.S. Farm Credit, I really think the principles that we'll be discussing have much broader application than in farm credit. There are a few specific things to farm credit, but most of this is very general. And the way I would like to approach this is to talk about some concepts and at the same time intersperse some practical applications and some examples of how you might use some of the things that we're talking about. Before we get too far into it, I want to just elaborate a little bit more about the United States Farm Credit System. It is a government-sponsored enterprise, which means it was created by Congress in 1916. So we're approaching our 100th anniversary. It did become farmer-owned in 1968 when the farmers were able to buy out the stock that the government held. And it has a clear public mission. It's not like Fannie Mae or Freddie Mac that have private stockholders. It's a clear public mission that's set by Congress. It does, because it's a government-sponsored enterprise, it does have the implied government backing, which I would emphasize may help keep funding costs lower. But if you talk to the investors who buy the bonds, what they will tell you is that they buy the bonds because the farm credit system is financially very strong and earnings are very strong as well. So But there is a possibility that investors are also thinking that the government might step in case the Farm Credit System got into trouble. Since that happened many decades ago, I think it's highly unlikely that that would actually happen, but that could be an issue. It has a cooperative structure, which means it's farmer-owned and the benefits accrue to the farmers. And we do have a strong independent regulator in the Farm Credit Administration, which has a 3-member board of directors and a full staff. And one final thing is the Farm Credit System Insurance Corporation, which in the event of a default of a farm credit bank, the Farm Credit System Insurance Corporation would step in and insure investors in that event. So the farm credit associations pay into this insurance fund, and in the event of a default, the investors would be at least partially covered. This is a map of the Farm Credit System, and what you'll see is it's a patchwork of associations across the country. There are 78, and in fact, some associations are overlapping with other associations. And the biggest association in the country is right in the middle of the country. It's called Farm Credit Services of America. It's about $21 billion in total volume. But the associations that I represent are from the Northeast. It's Farm Credit East, which includes most of New England, part of New Hampshire. Yankee Farm Credit also is in New England. And you can see AgChoice Farm Credit, which is in Pennsylvania. So that's the geographic region for the associations that I have had some familiarity with. And just some quick information about AgChoice and Farm Credit East. Just to highlight a couple things. What you'll see is Farm Credit East is significantly larger than AgChoice Farm Credit. The average loan size, however, for Farm Credit East is nearly double what AgChoice is, and that's partly because of the land values in New England are significantly higher than the land values in Pennsylvania, where AgChoice is located. You'll see that the top industries are the same: dairy, forest products, and grains. Farm Credit East does have the aquatic portfolio, which is the fishing vessels, and they have a cranberry industry, which is unique to Farm Credit East. AgChoice does not have that. And the other financially related services are identical. So what you'll see is a lot of similar things: difference in land values and difference in average loan size. And so you might ask, well, why don't Farm Credit East and AgChoice Farm Credit simply merge? Well, that's because the Farm Credit System associations, each one of the associations belongs to one of 4 farm credit banks. And what you'll see is AgChoice Farm Credit in Pennsylvania belongs to the AgFirst Farm Credit Bank, whereas the Northeast Farm Credit Associations belong to CoBank. And so this is probably what you might call tribalism, in that because of the relationships between the banks, we're not able to actually consummate a merger between associations in different bank territories. So that's just a little bit about the Farm Credit System. Let's get into the topic of loan portfolio management and things to think about. I think it really begins with the philosophy of the board of directors that govern the organization and their appetite for risk. And that's something that needs to be consciously determined. I don't think you can just let it happen. And to figure that out, I think there's some things that you have to do. The first one is, I think you need to have enterprise risk management protocols. And by the way, some of the terms that I use here, I'll give you some references at the end that you can go back and look up information if you're not familiar with it. But enterprise risk management is a formal, structured way of looking at all of the risks of an organization, not just loan portfolio management. So even though we're talking today about loan portfolio management, there are many risks that have to be considered. You have to have a formal approach to evaluating those risks. You need to have a business plan, which includes goals, targets, limits. You need to have policies and procedures for making loans. You need to have some underwriting guidelines so that the people in the field understand what kinds of loans can be written, how they should be written, how they can be approved, and so forth. You need to have controls, monitoring, and stress testing in place. It needs to be integrated with financial and capital management. So you can't just think of the loan portfolio without thinking in terms of how are we going to manage capital in the organization and what are the overall financial implications of what we're doing in loan portfolio management. Another thing that's essential is an audit and review process, both internal and external. Internal, you want to be sure you're not fooling yourself, and external, because you want to be sure that you're not overlooking something, that there's no fraud going on, and that you've got an independent pair of eyes looking at what's going on in the portfolio. A little bit more about enterprise risk management, and I will just share what I believe are two fundamental characters of risk. Stuff happens is the first one, and in the United States we have a different term for stuff, but I think you know what I mean. Stuff happens and you don't know what you don't know. So what that means is you can expect that there will be difficulties down the road, but you don't know what everything that could go wrong might be, and so you have to have contingencies in place. You have to be sure you're financially well positioned to withstand any of the adversities that could happen, whether you can anticipate them or whether you can't anticipate them. And one of the ways you can help understand what your risk appetite is and what your risk profile is by doing an annual risk survey following enterprise risk management protocols again. So for a series of possible events that could happen, you want to determine the degree of harm if the event should occur, what is the likelihood of that event occurring, and then what is your ability to actually manage if the event happens. So degree of harm if the event occurs, likelihood of the event occurring, and how can you manage it should it occur. And I'll give you an example here, I think. This is an example. I did an excerpt from one of the ones that we use at AgChoice. And what we're looking at here is loan portfolio management risks. And so you've got 4 questions that are posed here on the credit portfolio. What is the risk with lack of diversification in our loan portfolio or hold limits which are too large on a single credit? So what is the significance of the risk? What is the likelihood that it'll occur? What is our ability to manage it? And you'll put a score in here, and it will automatically populate a result up here. So this is a spreadsheet that we use for all of the major risks in the organization. And there would be some 40, maybe 45 questions, something like that, in the overall survey. And if anyone would like the survey at the end, I've got my email address, and I'd be happy to share that with you. So this is the annual risk survey. Once you do that, you need to be sure you've got policy in place that includes goals, targets, and limits. So you start with your risk appetite. You identify the key risks and identify some key performance metrics that you want to measure. Include all of that in a strategic plan. Develop your portfolio management practices, and then write your underwriting standards. The major risks that you might think of in an organization, a bank or a financial institution like within the Farm Credit System, this is a laundry list of most of the major risks. But the ones that we're going to be talking about here have to do with credit, financial, and in particular loan portfolio management risks. You can probably think of other risks. And the fact of the matter is that there are significant differences between countries, which I'll get into in just a minute. There are really 4 major risk management options when you're dealing with risk. And you can avoid the risk. For example, you don't make any coffee loans. Well, does that work if you're in an area where all you have is coffee loans? Well, that may not be an effective way to deal with it, but there may be other things that you can do. You can mitigate or reduce the risk. For example, get government guarantees. You can transfer or share the risk, require insurance, or participate the loan with someone else. So if you are in an area that's got nothing but coffee, maybe you can participate with somebody who has bananas, for example, and share some of that risk. And sometimes all you do is you accept it or manage it. You just have to say, there's nothing we can do that's cost effective. And the one thing we will do is make sure our capital is adequate, make sure all of our other policies and principles are in place the way they need to be. So those are the 4 major ways of dealing with risk. I think it's important to recognize that there are country issues when you're dealing with loan portfolio management and risk management. And certainly political stability in a country is important. There have to be laws and respect for law so that people feel secure. Basic needs have to be met. I mean, loan portfolio management is not going to work if you don't have basic needs met. The issue of literacy and numeracy, I have spent some time in Africa, and I understand that is an issue. Everyone seems to have a cell phone, but they're not always able to write, and they aren't always able to work arithmetic, but they have the cell phone, so they have the ability to communicate. Land ownership and property rights have to be spelled out. And the financial system infrastructure in many places, it's a difficult thing. It's not there. And then there's this issue of tribalism, which results in a lack of trust and corruption. And frankly, when I showed you the patchwork of associations in the United States, that's an example of tribalism here, where my way is better than your way, and it leads to inefficiency, frankly. We're not using our capital in the farm credit system as efficiently as we might, simply because of tribalism in the United States. So the United States certainly is got issues along those lines as well. Here's an example of some underwriting standards, and this is one where this is called owner equity ratio, and the definition is there. It's total equity divided by total assets times 100. And we set different underwriting standards for different industries, and those standards can change from time to time depending on the state of the particular industry. So, for example, if a loan dairy account has less than 60% owner equity, then something else has to happen. Either somebody else has to approve it, or maybe we don't make it, or some other thing has to happen. So it's not just go ahead and make the loan if it doesn't meet the standard. There's got to be something else going on. And you can see down here, we've got poultry or livestock contract production. That's where a farmer contracts with a large producer, and for that we require, for example, 35% owner equity. So this is just an example of an underwriting standard for owner equity. Another underwriting standard has to do with term debt coverage ratio. This has to do with the ability to repay the debt. And in this example, this really is a organization-wide standard, so every loan has to have a 125% term debt coverage ratio. If it doesn't, then every loan has to be approved by someone else, or something else has to happen to it. Well, that's just another example of an underwriting standard. Here's another one. We have credit scored loans. And I put this in here in particular because I've seen some credit scoring systems where people gather immense amounts of information, but whether or not it has any statistical value is questionable. And in our system, it includes, there are really two aspects of it. Non-financial factors, which is basically the credit score that you would get from a credit bureau, which includes repayment history, job tenure, time at address, current address, and then three financial factors: liquidity, earnings, net worth, and all of these things are rigorously validated, which means we know that there is a relationship between these things and the likelihood of the borrower actually repaying the loan as scheduled. So we do use a credit score loan, and we'll have a standard, for example. This is just an arbitrary number that's in here. It might have 185 as the target. The minimum would be 170, so no loans would be written under 170, or something else has to happen. So that's on credit scored loans. Here's a way that we price loans based on the loan size and the risk rating associated with the loan. So if you look at the yellow column here, these are the risk ratings, and you can categorize them 1 to 4, 4 to 5. These 4 categories here are the generally are acceptable categories. But if you get into OAEM, which means special mention or a loan with some weaknesses, or an adverse loan, then you might raise the margin. So what we're saying here is you're going to have, let's take an example right here, a loan over $250,000 in the risk rating 8 to 9 category. We'll have our base rate, which might be, say, for example, 4%. We will add 25 basis points, so the rate to the customer on that loan would be 4.25%. So that's how we use this. What we've been able to establish is that the larger loans, once you get over a certain size, it doesn't cost as much to service the loan, even though the risk may be higher. And we've accounted for that in here in terms of the interest rate adjustment. Moving on. This is another underwriting standard, loan to value. So for example, we will say that we'll make a long-term real estate loan, but the loan amount divided by the appraised value has to be at least 75%. Well, it can't be, 75% is the standard. It cannot be more than 85%. So a person must have 15% down payment or we won't do it. So the standard is 75%. We'll go above that in some situations, but it depends, it's situational. So in some cases, we will go above that amount. Let's look at some examples of goals or targets. And in our case, we will have a target that says we want 20% of new loans to be to young, beginning, small, minority, or veteran farmers. So that's just one example of a goal or a target. Or another one is all new loans to a particular industry have to meet underwriting standards, no exceptions, or have government guarantees. So you might do that in a situation where an industry has gotten into some difficulty. In our case, for example, dairy is doing well now, but there are times when it has not been doing well, and we might say, okay, all loans must meet the underwriting standards or they have to have a government guarantee. Another goal or target would be to have crop insurance required on certain kinds of loans. And you might have as a target that at least 40% of your borrowing customers use some of the other services of the bank, and you can set individual targets for that. Concentration limits. This is where, in some cases, we in the United States, we'll have some farm credit associations where they've got nothing but dairy farms. And sometimes the loans are very large loans. So what we'll do is we'll say no more than 3% of our capital will be lent to any single borrower. And we might say that no more than 60% of our capital to any single industry, for example, the swine industry or the dairy industry or the cocoa industry. No loans to certain industries. We have had situations where all of a sudden the government decides to impose new regulations, and so there's a lot of uncertainty about whether or not an industry is going to be able to operate in an economic model situation. So we might say no loans to certain industries. That doesn't happen very often, but it's possible it could happen. And then we might limit our capital markets or our participation loan volume to 20% of total volume, which means we want to be sure that we're serving 80% of our local market. And if we're participating with other financial institutions, we don't want that volume to be more than 20% of our total loan volume. So those are some examples of concentrations. Now, talking about loan terms or tenors, we have standards for short and intermediate term loans, which would be anywhere from 1 to 10 years, and long-term loans would be 10 to 30 years. An underwriting standard involving loan terms might be no fixed rate loan longer than 5 years. And so what you might do is use a 20-year amortization with a 5-year balloon or a bullet or something like that. And generally, we would match the loan to the effective life of the asset being financed if it were a single-purpose loan. Now, getting into loan portfolio analysis, I think it's important that you take several different approaches when you're analyzing the loan portfolio. And we use a method called strategic credit risk management. And what that involves is looking at the portfolio 3 different ways. We'll look at the individual risk ratings on each loan. We call that transaction risk. So the individual risk ratings. Then we'll also look at the risk inherent in certain industries or lines of business. For example, if we're financing a lot of part-time farms, maybe we want to limit, if we're financing part-time farms where the repayment is dependent on non-farm income, and it's non-farm income from a single company, let's say Boeing had a plant and there are a lot of part-time farmers and Boeing got into trouble. So that's another way that you want to look at it. We call it intrinsic risk. And looking at pools of risk segregated in terms of homogeneous groups of borrowers, geographic, industry or line of business concentrations. For example, looking at loans in the dairy industry versus loans in the swine industry. So we look at the portfolio three different ways, and we have a system to actually measure each of those risks and come up with an overall portfolio rating. Now, talking about portfolio stress testing, what you want to do is ask some questions. What if certain things happen within the industry? So in this first example, in dairy, what if milk prices declined to $12 per hundredweight and continued for a 12-month period? So you want to analyze your portfolio with data on your customers that would answer the question of what would happen if the price of milk dropped and for an extended period of time. In forest products, what if housing starts weaken due to a dismal general economy? Under shared participation loans, what if a combination of factors such as rising feed costs adversely impact the portfolio and weaker housing starts adversely impact forest products and related borrowers? And a total portfolio, what if a combination of factors such as a weak general economy and weakness in the dairy, forest products, and capital market segments occur all at once? And in coffee, what happens if 30% of coffee plants are killed by disease? So you can run scenarios in your portfolio and determine what the outcome, what the impact would be. And this is just a table where we would use this sometimes where we can actually plug in the stresses that we want to see. So we would look at business income, business expense, might look at subsidy payments, wages and salaries, interest rates, the ratio of non-current assets, and the overall credit score, and see what happens in the different industries if this shock happens. And you look at each industry individually, but you also look at the overall impact on the portfolio. And then you get results of the scenario analysis. And it starts with a base case. And what you would do here is you would look at projected end-of-year credit quality. And so in the base case, this is what you think is going to happen. This is what you think your non-accrual volume would be, what your criticized assets would be, what your net income would be, your return on assets after tax, your liquidity, your permanent capital. So this is the base case. And then you apply the shock, and what you see is that your acceptable credit quality would go down, your non-accrual volume would go up, your criticized assets would go up, and so forth. And you run this test for the various shocks for the different industries, but you also do it on the total portfolio. Because what happens if all of these things happen all at the same time? So this is a table that just shows you what happens. And in terms of not just the portfolio, but the overall organization. So you want to run a financial stress testing scenario that shows you what happens if the entire portfolio is affected by something like an increase in cost of funds by 300 basis points, or a decrease in your margins by 75 basis points. This would be the profit on the loan. Or an increase in cost of funds by 300 basis points and a decrease in margins by 75 basis points, all at the same time. What would happen to the bottom line in the organization if those kinds of things happened all at once? So you run those stress tests on the total portfolio. In terms of monitoring and reporting, I think it's important that you have good management reports that are easy to understand. We talk about a dashboard here, and I'm going to give you an example of a dashboard in just a second. But you want a dashboard that allows you to really visualize what's going on in the portfolio. You need to have that internal audit and credit review that I talked about earlier. It's important, I think, to have a committee that looks at asset liability, the balance there. There should be regular board reporting of exceptions. So when I talked about those underwriting exceptions, if a loan doesn't meet those exceptions, what do you do with them? Well, I think somebody needs to be looking at the exceptions that are being made, how many are there, and what is the trend. There needs to be a bank audit. So, for example, AgChoice Farm Credit belongs to the Ag First Farm Credit Bank, and that bank comes in and does a bank audit. And we have our own independent accountant review And sure enough, we've got a regulator, just as you all do, and our regulator comes in and they look at things with a fine-tooth comb. And I think that's good. It makes sure that everything is above board. Sunlight is the best disinfectant. Things to monitor: credit quality trends and migration analysis. What's happening over time with your credit quality? And you see blocks of loans that are shifting from acceptable to special mention to adverse. What is your risk-bearing capacity? Are things deteriorating to the point where you need to be sure you're building capital? Delinquency monitoring. What are the trends there? The industry risk migration. Is something happening in a particular industry, and at what pace, and what's the outlook? Large loan concentrations. Do you have too many large loans with a particular customer or in a particular industry? And counterparty risk analysis. This turned out to be a very important one in the financial crisis in 2008 and 9, where financial institutions failed and where we thought we might have support or good guarantees or good servicing of loans that we were participating with. It turned out we didn't. And so understanding your counterparties, the banks that you're participating with, is very important. Make sure you have a contingency plan or plans, not just one plan, but a series of plans in terms of the things that when stuff happens or the things that you don't know. And look at competition. We have competition in the commercial banks. I didn't mention this earlier, but in the United States, the banks in the farm credit system have about the same amount of volume, about 40% of the total ag loan volume is shared between banks and the farm credit system. There are things that you can manage: your portfolio diversification, the lines of business or the commodities. Are there ways that you can diversify your portfolio either by finding new markets within your local service area, or do you have to participate with other financial institutions to get the diversity that you need? Or can you get credit enhancements either through government guarantees or other kinds of NGO guarantees? What is your hold position on loans? Sometimes we found that we're holding too many large loans or too many loans in a particular industry, and you need to figure out whether or not some of that risk ought to be offloaded onto someone else where you participate those loans. And you can manage your growth targets. Sometimes you're pricing too low and you're growing too fast, or sometimes you're pricing too high and you're growing too slow. So you can manage your growth targets in different ways. And it's important to always be looking at your capital. Always know your allowance for loan losses. Make sure that it's adequate. And that's in the context of what's going on in the general economy, what's going on in your organization, what's the outlook. Excuse me. And you need to have an understanding of economic capital. That's basically the capital that's necessary on an ongoing basis. And you need to monitor certain ratios. Criticized loans and the adverse loans to capital ratio is an important one. And this is the one thing that's unique in the farm credit system, is that we do pay patronage or dividends to our member owners. And sometimes if an institution gets into trouble, it can reduce the amount of patronage it pays, or if it's flush with cash, it can pay extra. So those are ways that capital can be managed. I want to give you an example of something that we had in the farm credit system, and it was called an economic risk capital model. And basically, I call it the black box model. That's what you see here is the black box. And so what we would do is we would dump our loan portfolio data into this black box. And this black box is serviced by a company that has a proprietary system, so we couldn't see what was going inside the box. But this is what we knew, is that the data was going in, and all kinds of things were happening inside the black box. And there's a smiley face, and out comes the answer, the amount of economic capital that we need. And that was all well and good, but the question is, what's going on inside that black box? Do we really understand it? And can we do some stress testing and do some sensitivity testing on certain aspects of our portfolio? And if you can't do that, then you have to question how good that economic risk capital model is, how good that system is. So that's just something to be careful of. I only throw that in here because it was something that we encountered. Now here's something that we use regularly, and this is monitoring our trends with certain benchmarks. And I know it's a little hard to read here, but the benchmarks that are set over on the left-hand side, you'll see 3 columns. You'll see 1 rating, 2 rating, and a 3 rating. And what you want to be in the Farm Credit System is a 1 rating. And so let's take the example here, I've got it in green, of permanent capital ratio. At the end of June, it was 17.71%. And to be a 1 rating, it says you've got to be greater than 15%. Looking down at non-accrual loans in the red here, the non-accrual loans was 1.58%. And in order to be a 1 rating, you've got to be less than 1.5%. So this is a category where we were in the 2 rating system. And one of the things you can do is monitor the movements. You can look at what's happening over time, monitor the particular movements on a short-term basis, and you put that in front of everybody so they can see what's happening with the capital ratios, the assets, earnings, liquidity ratios, and this is what our regulator looks at. So we're monitoring this ourselves because we know that this is important to our regulator. So it's just an example of a way to monitor trends with benchmarks. Another thing to monitor is payoffs. Why are loans paying off? Is it for good reasons or because of competitive reasons? And this is hard to read as well. You can look at this later and you'll see that what it's telling us is what loans we're losing and for what purposes. So this tells us how much we're losing to competition. So it's just an example of another thing that's important that I think you need to monitor. What's happening with your margin in the portfolio? The forest products margin is the highest. The lifestyle or part-time farm margins are here. Participation loans, because they're extremely large and relatively low risk, the margins are smaller. But what's happening to those margins over time? So that's another thing that we monitor. Here's the dashboard I talked about earlier. And I like this because it sets out the key performance indicators that you're interested in, how they're measured, what the acceptable range is, what is the range of good performance, where it actually is, and then you put a color code in there. You can see at a glance whether it's where it ought to be or whether there is something you need to be concerned about. This is an example of concentrations are too high. And then what's the risk outlook? So you put in a comment here about what's the risk outlook. And in concentrations, it's not good and the risk is increasing. So this is something that has to be dealt with. But this kind of a dashboard, I think, is a good example of a way to really visualize clearly what's going on in your portfolio. And action or contingency plans. I did a laundry list of what I think are some examples of action plans or contingency plans that you could put into place if it were necessary. And you want to have them all listed somewhere so that if a situation happens, you can say, okay, we're going to pull this one out. For example, limit loans to new borrowers of risk rating 7 or better, enhance pricing to risk and limit terms on large revolving lines of credit, and so forth. I'm not going to go through the whole list, but you can go down there and see some examples of actions or contingency plans that I think you need to have. And this is where I'm going to conclude. This slide is the slide I began with, except for one thing. I had 7 requirements listed on my first slide, and here I'm listing an additional one, and I put it right at the top. It's people, because you need to be sure that in order for a loan portfolio management or risk management system to work at all, you've got to have skilled, competent, trustworthy people. So without that, none of this that we're talking about here will work. So it's really probably the most important thing is making sure you've got people you trust and who are trustworthy. And going down through the list, we talked about enterprise risk management, and I encourage you, if you're not familiar with it, to look up the topic because it's another several hours discussion, I think. You have to have goals, targets, and limits in your strategy. Your strategy needs to include policies and procedures, underwriting guidelines. You should be monitoring doing monitoring, stress testing, and have proper controls in place. It should be integrated with financial, capital management, and a rigorous audit and review process. Now, here's my email address. If anybody wants additional information on any of this information, I'm happy to provide that. And I put the addresses of Farm Credit East and AgChoice Farm Credit, which is who I'm most familiar with. And finally, I've got some references and resources here. If you can access this PowerPoint slide, I'm told, and you can go to those resources. I don't expect you to write it down here, but I just wanted to make you aware that those resources are there, and I would encourage you to take a look at them. And if there's anything else that I could help you with, please don't hesitate to ask. And with that, Maria, I will conclude. Thank you very much for this opportunity.
Allyn, thank you so much. It was a very interesting and enriching presentation. Before we launch into the Q&A, I just would like to remind everyone, if you are having difficulty seeing your chat box, make sure have an ag loan portfolio system. Many of the banks that we engage with are full commercial banks, so ag is embedded within the larger, offering of services that they or markets that they do. So it's not just agricultural finance, as in the Farm Credit East operation. So if you could speak a bit about, if you had to give advice, I know you've been out in Nigeria and other markets that we're talking about. You could talk a bit about how a bank would start if they really wanted to get serious about portfolio loan management of their ag portfolio.
Well, I'm going to guess that if you're part of a division of a larger bank, the bank probably does loan portfolio management and risk management strategies, but most likely they may not have a lot of expertise in agriculture per se. So I would start small. Frankly, when I spent 8 years in commercial banking before I came into the Farm Credit System, and we just had yellow sheets of paper that we kept track of information on. So I think very simple spreadsheets is a good place to start. But I think starting with a system, an outline along the lines that I talked about today, and you can do it in a very simple spreadsheet system. And the other thing I ought to mention here is that Farm Credit East and AgChoice are really mid-sized farm credit organizations. And there are the largest farm credit association in the country, Farm Credit Services of America, actually embeds everything that I talked about into one system. So it does everything automatically. It actually automatically makes the decision, and there's very little human input. Now, that sounds terrible, but it turns out that their program really works very well. And so that's one extreme. And the other extreme is just developing very simple systems, very simple spreadsheets, where you have to have a system to gather the data somehow. And I'm guessing that most banks would have that. And then you compile it and then put it into your own system where you can evaluate what the risks are. So I don't think it has to be terribly complicated, but you do have to have a way of gathering and compiling the data and then summarizing it and analyzing it on a regular basis. And you can do that on your own, or you can tap into the system that your financial institution probably already has.
Mm-hmm.
And I could help develop some of those systems if anybody wants a little help.
Thank you, Allyn. I wonder if you would be able to speak to us a bit about your personal experience. You have this deep experience and highest level of leadership in these associations. I think the rationale, we understand the rationale for having a portfolio management system in place, but could you speak about a time when that really helped avoid a certain, major problem or risk to the overall performance of the association, and how that system helped avoid that, or where the system had some weaknesses and it really caught you guys, behind the 8 ball, as we say in English? But,
well, I can tell you a time when we were getting concerned about our level of capital. We thought that it was in the best interest of our customer owners to maintain as little capital as possible, while to leverage that capital as effectively as possible. It's the customer owner's capital. Why should we be hanging on to it in the organization? And so we kept trying to pay out as much patronage as possible. And we did that until the crisis hit in 2008, 2009, and we realized we were really undercapitalized, and the stuff happens and you don't know what you don't know. That hit us right between the eyes. That's when I learned that lesson. And what I took away from that is that you've got to be sure you have adequate capital in place to take care of those kinds of situations. But one of the things that we can do, and we saw this happening where our marginally acceptable loans in the dairy industry, we're putting on more and more of those. And we said, wait a second here. If this industry takes a nosedive, we could have some difficulty with some of these borrowers. And so we raised our underwriting standards when we saw that we were putting on too many marginally acceptable loans. And I think that saved us. And we probably caught on to that a year ahead of when the downturn hit, which was in 2009, when the dairy industry in the U.S. hit the skids. And because we were monitoring that, we were able to turn it around before it impacted us too adversely.
Okay, thank you. I have a question coming in. I think it's from Afghanistan. I'm not sure where the participant, but they're concerned about if you have any guidelines in terms of monitoring the portfolio or incorporating frequent adverse weather events, in terms of, in their case, disasters and flooding. How do you incorporate that into your systems, your portfolio systems, or your precursor to that, your early warning systems and your decisions on loans?
Well, what we do there is that there are certain loans that are definitely subject to weather events. And in the U.S., we have a good crop insurance system. And so if we've got a loan that is highly leveraged, let's say a maize loan, we might say, okay, we're going to require crop insurance at a certain level on this particular loan because of the danger of adverse weather. And in fact, we have collected on those kinds of loans frequently in the past several years. In the Midwest, we had a very significant drought a couple of years ago. This year, it's not so bad. In fact, we're probably looking at a record corn crop. But the crop insurance that was put in place paid huge dividends. So you can't, it's hard to anticipate that, but what you can do is you can say, okay, we've got a loan that's a little bit stressed, and we're going to require crop insurance before we make additional advances on this loan. So you build that into your underwriting standards. Okay, great. Thank you. Now, there was something that struck me when you were talking about concentration limits and this discussion on how these decisions are made specifically. I wonder, in your experience, how does the bank strike that right balance between, let's say there's an industry that's growing particularly well, and you have your business, sort of the business objectives, really, you want to go out for that market, but then you want to strike the right balance between not being overexposed, if the market's too hot.
Can you talk about how those decisions are made in negotiation? I imagine it's a negotiation between different departments in the organization, or is that really a strategic level decision at the highest, at the board? You started out talking about that at the beginning.
Yeah, I would say that's a strategic decision because you want to be sure you're serving your market. And even if you have a high concentration in a particular industry, you do want to continue serving a particular market. So you've got to find ways to be able to do that. And one of the ways is by laying off some of the risk on a partner with another financial institution, or requiring that crop insurance, or making sure you have adequate capital. You might raise your capital level. In other words, pay less patronage to your member owners and raise the capital level if you're going to keep higher concentrations. By the way, in the Farm Credit System, the regulator says that if you have an industry that represents more than 10% of your loan volume, that is a concentration.
Okay.
So that's probably going to shock some people where you have single industries, but that's what our regulator says. And in fact, I don't think they're too far off. I really think that that's a good guideline.
So the regulator here in the U.S. puts the brakes on. So you have some sort of external mechanism, or is it? How does that work itself out in terms of your overall evaluation from the regulator?
Well, so that they'll say 10% is a concentration, but we have 25% in the dairy industry. So what that means is we've got to be sure that we've got strong underwriting policies in place, that we've got adequate capital, more capital than an association that doesn't have that kind of a concentration risk. It doesn't mean we can't do it, but we have to be doing other things properly in order to be able to continue with a high concentration in a particular industry.
Okay, so there are specific things that a bank can do, irrespective if they want to go in, but they have to. I guess the message is they have to go in prudently by the strong underwriting, provisioning, having the adequate capital ratios in place, and making sure that perhaps share some of that risk with their partnering financial institutions.
That's right.
Interesting. I have a question here coming from the Latin American region, and this individual is interested to know, do you have any specific experience or points of view on the Latin American market related to agriculture and financing of agriculture? So it's a pretty general question, but the individual is interested to hear your perspectives on that. If you do, if not, you can follow up with that individual post-webinar.
Well, I can do it both ways. I do have an interest in Latin America, especially in coffee. I've got some friends in Costa Rica and in Honduras that raise coffee, and I understand that they have serious issues there, especially with the coffee rust right now. So if there's something particular that the individual has a question about, just give me an email and we can follow up on that discussion.
Okay, that's fantastic. Thank you, Allyn. Allyn is just an incredibly open and accessible individual. When he says, please do email me, he means it. So I do want to just give a pitch out to everyone to do follow up with Allyn with your specific questions. I have another question coming in from South Africa. In this market, the greatest challenge is how do they deal with the large portion of small-scale farmers. Banks in Africa, Southern Africa region, East and Southern Africa region, and writ large in Africa, struggle with servicing several thousand small-scale farmers, and they're struggling with ways to do that. And this person's interested to see how they can manage those risks with serving such small-scale farmers that are often highly dispersed across the rural markets.
I'm going to guess that that's probably the biggest issue that the people on this call are experiencing. And I've seen this in Ghana, in Nigeria, and in South Africa, for that matter, and in Central America. It's a huge issue. And Maria, I'd love to spend a lot of time talking about it, but I think it's another hour discussion.
Yeah. Okay.
But I think about the principles that we talked about here, because I think the principles have general applicability. It's not just about the Farm Credit System here. And so I do have some ideas on how to serve some of those widely dispersed smaller customers.
I think that To our participant that asked that question, I will make a plea that you do follow up with Allyn, but I will say to everyone, this is an important topic, of course, to AgriFin and everyone online, and so we will do our best to come up with perhaps a different way that we discuss this, maybe through panels, bringing in different points of views on this, because there's a lot of piloting and testing going on. We ourselves are delving deeply in sort of what are the different aggregation methods that banks can use to manage those risks, mitigate those risks, and get their costs down. So it is an important topic, and I really do think that we need to delve deeper in that and bring many more minds to this this issue. So that's a commitment from us to you, and we'll do our best to sort of hit that issue. Just before we leave, Allyn, you may run for the hills because we are now asking you so many questions, but this enterprise risk management survey you talked about early on, is this really something that people can walk through, can go, or is it something that would require a facilitated discussion where you walk people through the survey, how it works? Is this an off-the-shelf thing that someone could adapt to their banks?
Yes, it's something that we create. The one I gave you an example of is one we created at AgChoice. I'd be happy to share it with you. So just let me know that you'd like it.
Okay.
I'll send you the spreadsheet, but it will require a little bit of discussion about how exactly to use it.
Okay.
And it will probably require tailoring to your particular situation.
Okay, well, perhaps we'll put that on a future webinar topic, and what we'll do is send out a targeted blast to our audience to see if interest in that. I do believe in bringing things that are of relevant interest to them. So let's talk about that. I'd love to get in and see it myself and see how we can bring that to everyone. So on that note, I'm cognizant of the time. We're here at AgriFin. We're very disciplined in keeping to our 1 hour time slot. I know we could go on speaking for another good hour here with Allyn, but unfortunately, we're going to close out today. Before I leave, first and foremost, I'd just like to say thank you, Allyn, for taking time out in your busy schedule and your graciousness in sharing all of your experience and your knowledge on this topic and related matters. Thank you. I just want to let everyone know that this recording will be made available shortly on our website. Everyone that signed up, of course, will receive the webinar recording in PowerPoint directly. What we'd like to ask you is to be sure that you share this with your colleagues, because I think that that's one way that we can really exchange and share this knowledge and build knowledge. And then, use it as a, sitting around lunch table discussion about how you could implement this in your own banks. Before we end today, I'd just like to ask everyone, you'll see a nice little survey that's appearing on the right-hand side of the screen. It's very helpful for us to improve how we bring this service to you. So if you could be very candid in your comments and remarks when you fill this survey out, it takes 2 minutes of your time. We really, really appreciate it. Next, just a heads up, we will be bringing you experience from AMRIT in Cambodia with their experience in lending to SME enterprises in the agricultural space in their country. And that is tentatively scheduled for next month. We'll be sending out an email invitation in the coming weeks. Lastly, be sure to send us an email, or as Allyn said, get in touch with him directly if you have specific questions on today's topic. On behalf of the entire AgriFin team, I'd like to thank Allyn and to thank everyone for joining us today. I thought it was, for me personally, a very enriching discussion, and I learned a lot, and I look forward to learning more on this topic in the future. So thank you again, and I'd just like to wish everyone to have a good day or a good evening wherever you are in this world. Thank you.